So I'll just formally introduce Rajan. I'll take a minute to do that. So Rajan is a managing director at Surge in Sequoia Capital. As a part of leadership team at Sequoia Capital, Rajan is focusing on developing Surge into world's top scale-up program for startups by acting as an investment advisor and a mentor to program's founders. Surge aims to engineer rapid early progress for startups by enabling disproportionate access to capital, talent, network, and decades of company building knowledge. Rajan's deep understanding of technology, operating expertise, and a track record of growing tech businesses across the region will definitely help Surge's founders scale and build businesses of tomorrow. Prior to Sequoia, as the VP of Google India and Southeast Asia, Rajan played a key role in expanding the region's internet ecosystem while accelerating Google's innovation and growth in the region. He's also a prolific angel investor and obviously one of India's leading, who has backed a large number of successful startups at very early stages. Rajan also led Microsoft and Dell in India, worked for Michael Dell, the founder of Dell, and was earlier a partner at McKinsey and Company in Chicago. Welcome, Rajan, to this wonderful webinar. So getting right to it and not wasting a single minute, just a note to participants, if you are, we'll be obviously having the panel discussion right now, but once it is over, you can raise your hands. As a facility to raise your hands if you want to ask any questions to Rajan. There's also a Q&A box where you can ask any questions and I'll facilitate that. So Rajan, we'll get right to it. So we're good to go?
Yes.
So, obviously, as an investment banker, one of my first questions, and also with that entrepreneurial nudge, I think India is a hub for entrepreneurship, and today we are propelled by better awareness, availability of finance and other resources. However, the onset of this pandemic now has definitely caused multiple negative repercussions for businesses, of which large one is liquidity issues and slow.
Hey, Mihir, you're cutting in and out, Mihir. I think the feedback on this as well. You just have to get closer. I don't know what's going on, but your voice keeps coming in and out.
Just 1 second, Rajan. 1 second. Is this better now?
Yeah, that's better.
Okay, great. So basically, wanted to understand how, obviously these are tough times. So what are your thoughts on how entrepreneurs should tackle this big challenge and ride through the storm when it comes to liquidity crisis? Because a lot of them are today facing liquidity issues. So what are your thoughts there, to begin with?
Yeah, so I think, look, firstly, we're 4 months into the onset of COVID in India, right? From where we started with the lockdowns in third week of March. So I would say if you're a entrepreneur, well, the world that I live in now is really startups and startup founders, right? So I don't know who the audience is. Probably, mostly I'm assuming it would be startup founders and maybe there are other business owners as well. But I would say, at the end of month 4, either you figured out how you're going to extend your runway for the next 6, 8, 12 months, or you're pretty much out of money, right? And it's very different to where we were. Let's say when we were talking to our Sequoia founders or talking to startup founders more broadly, at the end of March, our message was this is going to last a long time. It's not a 1 or 2 month phenomenon. That's clearly played out. And our big message was, look, and our counsel really was that you've got to extend your cash runway, right? And we said at the end of March, you should really try to get at least 18 months of cash runway, if not for 24 months of cash runway, because this is not a 3-6 months phenomenon, and that's really played out. So I would say today, either you found a way to extend your cash runway, either by dramatically reducing all aspects of your cost structure, or you've tried to find finance, find some bridge financing or new round of financing, or you're pretty much out of money, right? And if you're pretty much out of money, then you really have only 2 options. Either you find a home for your business, for your startup, i.e. a sort of an acqui-hire or acquisition type thing, or you unfortunately we'll have to wind down. So I would say, look, I think that question was very relevant in March and April. But as we sit here at the middle of July, every startup founder has found either a solution or has decided to find a home for their company, right? Because, if you're sitting here still trying to figure out what to do about COVID, that's a really bad place to be in.
All right. So yeah, most of them would have, and we've been hearing the same thing. I think the runway is clear there. However, the pain will persist, and there's a lot of uncertainty. That's why I think some founders have been thinking about it. But coming to financial capital, one of the questions that has always been asked for an early stage entrepreneur, at least, there are multiple, obviously, and correct me if I'm wrong, but Surge is also similar to an accelerator program. But early stage entrepreneurs have this choice of whether should I raise capital from a micro venture capitalist or an accelerator or an angel syndicate. How does an entrepreneur really, what are your thoughts there in terms of what should he think about when choosing the right partner, at least at an early stage?
I think it's a good question. Look, so first of all, right, fundraising is not the objective, right? I think over the last 5 years in India and globally, there's been so much written about, so much capital raised, and almost an obsessive focus on fundraising, right? Where startup founders today think that fundraising is the objective. Fundraising is not the objective, right? The objective is to build a company. And if you look at some of the greatest companies in the world, right? From in India, you look at a company like InfoEdge, to a company like Google, or you look at a company like Zerodha, either they've raised no capital, like a Zerodha, right? Is India's most successful fintech startup, right? In terms of revenue and profit, entirely bootstrapped, right? All the way through a company like InfoEdge, where Sanjeev Bikhchandani raised $1.7 million. And when he went public, when he took the company public, he had 1.5 million out of the 1.7 million still in the bank, right? Or Google, that just became $1 trillion company, only raised $25 million in its history, right? One round of financing, Series A. So I think it's important to keep in mind that as entrepreneurs, the best form of funding is your customers' money, right? Either get your consumers to pay or you get your businesses to pay, depending on your business model and monetization model. And I think in India, for many different reasons, primarily the prolific availability of capital that we've seen over the last 4 or 5 years, a lot of entrepreneurs, unfortunately, made fundraising their objective, right? And built businesses that were inherently quite challenging, meaning there wasn't a viable business model in there. So I'd say priority 1, 2, and 3 is, make sure you're building a real company that has the possibility of making, significant revenue, but more importantly, significant profits and cash flow over a period of time. And what I'm very encouraged about when I look at the Sequoia portfolio, the Surge companies, and also my personal angel portfolio of investing in India for 15, 20 years now, is companies have really pivoted, right? I mean, companies that quite frankly weren't focused on revenue became very focused on revenue. Companies that were focused on revenue with not so great unit economics now have much better unit economics. So I would say the 1, 2, 3, 4, and 5 is focus on figuring out how to generate high quality revenue. What I mean by that is high gross margin revenue. Make sure your contribution margin is not negative, because, look, if you're in a business where the faster you grow, the more money you lose, that is not a great business to be in 2020, right? That might have been a business that you could get funded in 2019 or 2018 or 2017, but in 2020, that's a terrible business to be in. So I think that's the most important message that I'd like to say when it comes to fundraising, which is, build a real company, right? As opposed to sort of wanting to be a startup and fundraising become your objective. Now, moving to the next, that with that as a backdrop, I would say, look, if you're an early stage founder, the question is, why do you need to raise funding? And then it becomes, how much you want to raise depends on why you need to raise, right? And then depending on what you need to raise, right? If you need to raise 20, 30 lakhs, that's a friends and family round. If you need to raise 20 lakhs to 1 crore, interestingly, the government has quite a number of grant schemes now where you can actually go out and raise. I'm amazed at how few startups actually leverage these grants, right? The center has many grants, MeitY has grants, DSC has grants. I mean, there's so many grants, every ministry has grants, right? And those are actually, they're looking for startups to approach them, whether it's 20 lakhs, 50 lakhs, 1 crore. Then if you're looking for, I'd say 50 lakhs to about 5 crores, I think there are many options now, right? India, angel networks. Indian Angel Network today is the largest angel network in the world. You have Let's Venture, which is the largest startup and investor curated marketplace in all of Asia. There's nothing like it, right? Thousands of investors, thousands of startups being listed. Just in the month of June, Let's Venture closed 9 investments, right? For, and these are not 50 lakh, 1 crore rounds. These are multiple, many crores rounds, right? And then, as you said, there are also a lot of seed funds, right? So if you want to raise 1 crore to 15 crores, I'd say a seed round today, I would classify sort of 1 to 2 crores up to about 15 crores, right? So Surge, we basically invest $1 to $2 million per company. before you start the program, right? So we actually give you the capital before you start the program so that you can then focus for 1 or 2 years on building the company. And again, not spending all your time fundraising. And then you have programs, right? Y Combinator gives you $150,000. You have Techstars. Then you have a whole set of funds that are sort of seed funds. And then you have seed funds that have graduated to Series A funds, funds like Bloom, and so on. And then you have all the venture funds, right? Whether it's Accel, Lightspeed, Saif, etc., that actually do invest in seed. So I would say 2 crores to 15 crores, you have a large number of options. And then in Series A, you probably have 15 to 20 venture firms, right? So think about it as, if you want to raise 3 million to about $10 million, right? And there you have 20 to 25 top quality venture funds that are still very, very active. So I would say, depending on the amount that you want to raise, make sure that you're going after the right capital source that you're trying to raise, right? And in fact, Surge, we did a very interesting partnership with Startup India, which is part of the government of India, where for 4 weeks, every Saturday, for 4 weeks, we had a webinar series that we had Saturdays. It was from 4 to 5:30, and the topic was raising your seed round, right? So this was focused on founders that wanted to raise anywhere from, let's say, call it 1 or 2 crores up to about 15 crores. And the first session that I did actually was around this topic, which is, when should you raise? How much should you raise? What are the different funding capital sources? And then I also talked about, what do investors look for? So that was the first part of the series. Second part of the series was around your pitch deck. So if there are founders on this call that are actually looking to raise.
Absolutely.
Yeah, they, just go. I mean, look, it's 1.5 hours. It's 4-part series. It's certainly, investing 6 hours will probably make you 10 times better in your fundraising than what you're doing today.
No, absolutely. And coming from you, I think investing 6 hours would definitely be worthwhile. So that's undebatable. But no, that's very interesting. But just delving for a minute on this again, one of the things that founders always aspire for is mentorship. And obviously, Surge also provides. I've obviously seen Kanalcha and all these guys on the board of Surge. How, I'm not, again, from that perspective, when you look at these financing options, what's your thought process there, Rajan? I mean, how important is mentorship? Because you're in the early stage, obviously, you know the best as a founder. So just maybe your thoughts on that.
Yeah, so look, I think it's very important to look for investors, right, who are going to have 3 characteristics, right? 1, understand your business deeply. Because, if your investors don't understand your business deeply, it's going to be very difficult for them to be partners with you for 10 or 15 years, right? It takes 10 or 15 years to build a valuable large company, right? Second thing, I think it's very important that they have the same set of, the same vision for what you're trying to build, right? Yeah. Because as a founder, you have a vision of what you're trying to build. Make sure that whoever you're going to, get as an investor is not only going to be somebody you're going to want to partner with for 10 or 15 years, but has the same vision of what you're trying to build. Because different investors, by the way, have different theses, right, of what what they think is going to be an interesting company and so on and so forth. And I think the last one is what gets to what you're saying, which is make sure that they can provide more than capital, right? Because you're going to need, as a founder, whether you're a seed stage or a Series A founder, it's going to take 10 to 15 years, and you're going to need a lot of help as you try to build your company. And it's important that you get an investor. And by the way, not everybody has the time to help you on all things or has the capability to help you on all aspects of building your company. But making sure that you have investors who, have at least 1 or 2 areas where they can provide, help on, right? And then, so moving to Surge, the reason, and by the way, for those of you that are not familiar, Surge is Sequoia's seed stage program. We launched it about 16 months ago, and the intent was to address in a very programmatic way the most significant challenges that we saw in the seed stage ecosystem in both India and Southeast Asia, right? So it's a program that covers both India and Southeast Asia. And those challenges really, fell into a couple of different buckets, right? First, capital, right? Because, and I'd been an angel investor for actually, for more than 25 years, but in India for 15 years. And most of my companies had to raise 2-3 rounds of capital financing before they got to Series A, right? And what that meant was if there were 2 co-founders, one co-founder, all they did was raise money. Because you raise 1 crore, then you raise 3 crores, then you raise 7 crores. So, because, before you got to Series A and you ended up diluting 30% of the company. And also, like, you didn't make enough progress because one of the 2 co-founders was, so one is capital, right? So making sure you have enough capital so you can focus on company building. Second to your point, look, really deeply understanding what does it take to build an enduring company and what are those design choices you want to make now, right? It could be as simple as what market to focus on, right? It could be as simple as how do you know that you have product market fit or not? It could be as simple as how do you think about hiring your first set of engineers and product managers, right? All the way through, how do you actually think about sales and so on? So that's number two. Third, there were areas like hiring, right? Where it's very difficult if you're an early stage company because you don't have a brand. You may not have networks, how do you hire a first set of engineers, your product managers, whatever? Can we provide hands-on support to that? And then the fourth one was, there were a lot of learnings, right, from other parts of the world, right? So whether it's the US, China, Southeast Asia, now India is leading the way where a lot of Indonesian startups are learning from India, is can we facilitate that and make it much easier? And then the last thing is, can we really bring to bear mentors? So for instance, at Surge, we have, several dozen of, unbelievably incredible mentors, right? Unicorn founders, deep specialists in areas like product, marketing, engineering, sales, so on and so forth. So that we can bring to bear to these companies. So what Surge is basically, we invest $1 to $2 million per company. It's a fixed round valuation. It's not a convertible note, right? So depending on the progress of the company, we agree on the valuation. Then we have a 14-week program where we take you through where now we are entirely online, right? So it's 1 day a week where we pick a topic that's very important. So for instance, we had a day on engineering, we had a day on product market fit, we had a day on product management, we had a day on sales, we had a day on growth marketing, and so on and so forth, where we go very deep, right, in terms of how do you really deeply think about each of these topics. And then we let the startups over we have 15 to 20 companies per cohort, and we let them apply those learnings, right? So the next week they'll come back, they'll talk about it, and then we have office hours in between, etc. And then as part of this, we also, not just the Sequoia Surge team, which is, very seasoned investors, but we also get, as I said, we have a large number of mentors and practitioners who actually mentor these startups on different areas that matter. And then what we also help them do is, at the end of this, for companies, whenever they're ready to raise their next round of financing, we have something called Upsurge, where basically over a period of 2 days, we help them raise their next round of financing, right? So I would say, look, the good thing about programs, whether it's, Surge or other programs that other firms run, or Y Combinator or Techstars, these are ways in which, programmatically, you can actually get help mentoring, right? But the other thing is, I'd say today, there are several hundred angel investors in India today that have actually either built companies or run companies, right? And those are the best, or they've been, sort of very seasoned investors, investing for 10, 15 years in startups. And they can provide a lot of value. So long answer to your question, but I would say, find investors who can provide more than capital, right? And it falls into 3 different buckets.
No, that's an interesting perspective. And again, I think at the behest of the entrepreneurs who joined the call, I'd spend a little more time on this. But because you mentioned and you talked about valuations, and that's something that is always on the mind of a founder raising capital, and especially at this time, right? I mean, what we've been hearing from investors, public markets has taken a hit, and there are a lot of at least private equity investors, and obviously there's a lot of contrast when it comes to private equity investing or investing in private companies vis-a-vis public companies. So today, how do you look at this entire valuation bridging? Because if you look at companies today, a lot of them obviously have gone through this curve where the numbers have not been good or the financials have taken a hit, but they still expect certain valuation numbers. So is it via structuring? And since you mentioned, obviously Surge does a fixed valuation round, but your observations there, Rajan.
Yeah, so firstly, by the way, Surge is, we basically value each company differently, right? So meaning it's not one valuation, it's not a convertible note, etc., because different firms have different approaches that they take to seed investing. So look, I would say, look, first of all, as a founder, and we say the same thing to our investors, right? Don't obsess about valuation. Look, there are 2 things, right? Either you need to raise money or you don't need to raise money. If you need to raise money, you need to raise money because you may run out of business, right? So let's say you have 2 months of runway or 3 months of runway, and you're currently in a negative cash flow position because you're in the process of growing the company, right? Reality is you need to raise money, right? Either people who are already on your cap table are going to invest in your company, or you're going to have to raise money. And, in that case, worrying about is the valuation X or Y or Z is absolutely the wrong answer, right? Now, if you don't need to raise money, focus on building your company, right? You'll be amazed at how investors find the best companies. What has happened over the last 4 months, just so that all of you know, is the valuations of the highest quality Indian startups have increased.
Yeah.
right? So in the public market, we've seen a flight to quality, right? Google's just become $1 trillion company, right? The best performing public tech stocks in the US have all appreciated through COVID, right? They have not declined by 50%. Same thing is happening in the private markets where the high quality companies, are still able to raise if they want to at even higher valuations. The second thing that has happened though, if the business model is generally unviable, right? So let's say you're building a consumer internet app and your retention is very poor, which basically means you have no product market fit. Today, you have no chance of raising capital. In the past, you might have been able to. So today we are in a situation where investors want to find the bar, if you will, right, has gone up even higher. And so it's really not about valuation, right? It's about, again, right, the simple way I look at it is if you're a startup founder, do you need to raise money or do you not? If you need to raise money, you need to raise money, right? If you don't need to raise money, what I would say is focus on making your business even stronger. Improve the underlying quality of your business, right? Increase the focus on what we call customer love, right? Do your customers love your product? It's the single biggest thing I look for when I look at a seed stage company that has already launched, right? Improve the unit economics of the business, right? Make sure that this is a viable company, right? And if you do that, what I can tell you is investors will come find you, right? The best way to fundraise is not to fundraise. Point number one, get customers to pay and get profitable. Point number two is have investors come and call on you. I can tell you, by the way, right? If I look at the, like the really, really amazing companies that are now Series A, B, C, D funded, they are being chased by investors even today because they've got very high quality companies, right? And so I would not worry about valuation. I think it's at the end of the day, right? Like founders should not worry about things that they can't do anything about. What can you do something about? What you can do something about is build a high quality business.
Yeah.
Improve the underlying quality of your business. And my view is, and this could be because I come from an operating background, right? Is focus on that and focus on execution. Now, if you need to raise, then you need to raise, right?
Yeah, absolutely.
Does it matter whether it's a 20% markup from the last round or whether it's a 20% markup? It doesn't matter, right? You've got to raise the round. So decide whether you need to raise or you don't need to raise.
So, I'll request a candid perspective here again. So some of the things that I have witnessed is that, obviously I'm going to deploy this capital in building growth and I'm sure, I'm going to make something out of this business. So why should why can't I be valued 2 years hence or 3 years hence, whenever, when I raise my next round? But just wanted to understand an investors, and because you come from the background, so your perspective as to why should entrepreneurs, or what should, a lot of entrepreneurs come with a restructuring request or something where obviously past investors have a certain price, issues because obviously because of multiple terms and conditions. So as an investor, from a structuring perspective, do you think it really helps or it really helps the founders? Or is it just a textbook mechanism to avoid valuation discussions today?
So what do you mean by structuring, Mihir? I don't know what you mean.
Or CCPS or any of these convertible notes which could give you the benefit of converting at a later date.
So look, if again, right? Look, I'm much more of a first principles kind of person, right? Do you need to raise or do you not need to raise? The answer has to be one of the two, right? It can't be I sort of would like to raise, right? So if you've got 18 months of runway, right? You're in decent shape. Yeah. Do you want to raise, try to increase it to 24 months? The reality is if you've got 18 months of runway, you can probably continue to adjust your cost structure and increase your monetization, right? Optimize your monetization where you can extend your runway to 24 months and then you're fine. Then what you should do is really double down on the next 12 months on increasing the quality of your business. But if you need to raise, look, it doesn't matter, right? Whether it's a convertible note, a fixed price round. Now, make sure that there are, in fact, those of you that are raising, in fact, the fourth part of our webinar series that we ran with Startup India with Surge was actually around term sheet and what to do, in diligence, right? What investors look for. So, like for instance, if an investor, so let's say you have to raise, okay, let's make it real. Let's say you have to raise and there's only one investor. You've talked to 150 investors as a founder. Okay, only one is willing to invest and they want a 2x liquidation preference. So what should you do? Well, if there's only one and you've talked to 150 investors, nobody is going to do it.
Yeah.
then you have to decide either you take that or you shut down, right?
It's a question of
if
survival.
you don't need it, then if you don't need it, you shouldn't be raising.
Yeah.
Right. So that's how I look at it. Right now, is 2x lick pref good? No, 2x lick pref is not good.
Yeah.
It should be 1x lick pref, right? But that's probably what they want. And you know, I mean, you do this for a living, so you could have 10 of these terms, right? Again, it all comes back to, do you need to raise or not? And if you need to raise, make sure you're talking to the right investors, right? But I would say today, look, the single most important question every single startup founder should ask themselves and their teams, right? Are we building a really high quality startup? Do we clearly understand what problem we're solving for which customer? Do we have customer love? And if you're a post-revenue company, do you have viable unit economics? And if the answer to any one of those three things is no, then go fix that first. Because today the bar from investors, Mihir, has gone up dramatically. Like I have no interest in looking at a consumer internet startup, right? With month 3 retention of 2%. And there are many of them. What that means is in the third month, only 2% of the people who downloaded this app are using it. What kind of retention is that? Actually, I have no interest in 10%. Actually, I have no interest in 15%. You get the drift? You know what I mean? So like if a third of your customers who downloaded your app are not using your app in the third month, have you really built a product that customers love? And the answer is no. The answer is no, right? You're absolutely. So this concept of customer love, what does it mean? It means whether you're a consumer, whether you're a teacher, whether you're a small business, whether you're a large enterprise, they love what you built. And what's the best way to measure what they've loved? It's retention or repeat purchase, right? Repeat purchase.
Yeah.
If they don't love it, they're not going to buy it again, right? You look at, there's many of you on this call. Look at your own purchasing behavior, right? There are lots of things you'll buy one time. There's an app you'll download, you'll never use it again. Trust me, that company ain't going to do well. So, and by the way, getting to customer love, especially as an early stage founder, is very difficult, right? Getting to product market fit is the hardest thing as a seed stage company. So my view is, don't worry about fundraising. By the way, I shouldn't say this because you're a banker, but don't worry about fundraising. Focus on building a high quality company.
Got it. So again, playing devil's advocate maybe, but who validates this entire, you very rightly said, at least for an early stage founder, customer love is tough to get.
Very simple. Look, depending on your category, you look at, so how do you know customer love? Okay. Retention is the single most important metric. Just look at your retention and figure out in your category, what is best practice retention and what is really bad retention, right? If you're building, let's say an SME app, okay, SaaS app in the SME space, monthly retention better be 35, 40%. That's really good. It's less than that, not good. If it's 10%, it's very bad. There you go, right? If you're building a gaming app, then the retention, right? So retention is one. Second, by the way, let's say you're a consumer brand that you're selling on Amazon. Look at your ratings. You have great ratings or you have bad ratings. Look at the best ratings in the category. Let's say you're selling a SaaS software for global SMBs. Look at your G2 ratings. And if you're selling SMB SaaS, what do you think the number one metric is? Churn. If you've got monthly churn of 3% as an SMB SaaS company, that is really bad customer love. What does it mean? It means 36% of your customers every year, without you doing anything, just go away.
And this should not come with any behavior betting mechanisms like discounting or like, I don't know. I mean, some of these...
you can discount, but if you discount, but you have terrible unit economics. Remember what I said, right? Third part is unit economics. See, basically, if your contribution margin, if you're CM2, you have revenue, you have gross margin, you have CM1, you have CM2.
Yeah.
If your CM2 is negative,
yeah.
The only hope you have is make sure that you have investors on your cap table that are going to fund you. Nobody else is going to fund you. This is really important.
And what if there is I'm delving deeper, and if it gets boring for you, please let me know. But how do you ensure that it is, so a lot of times funders come to us or even investors and say, okay, look, it's the journey. So today I may be here, and if there's a curve that we map,
that's fine, right? So what I'm saying is, look, let's say you're -2, let's take a real company, okay? A lot of these B2B e-commerce companies that are doing Kirana stores and this and that and whatever, right? They have 3% gross margin, They have minus 1% CM1 and minus 4% CM2. So help me understand how this is going to become a EBITDA 5% business. So walk me through the math. How is it going to happen?
Yeah, but that does not have any corporate costs attached to it. But I'm just saying, if there's a startup which is trying to acquire consumers,
what I'm saying is, you have to show the path, right? All I'm saying, your question was, let's say it's a path, it's a journey, right?
Okay.
And the problem is, seafarers like us who've seen a lot of journeys know what journeys can work and what can't work, right?
Correct.
Think about it, right? We had some of the world's largest startups, like let's say, okay? That pretty much had the same story, right? We're going to lose money for a long period of time and finally we're going to be profitable. Well, that hasn't happened. Eventually I think it will, because they'll shrink to profitability, right? So I think the key thing is, again, I'm just trying to be helpful.
Absolutely.
If basically the question we are asking we are asking three questions, okay? One, is this a founding team that is extraordinary? What do I mean by that? The most important thing is founder market fit or founder product fit. Is there a reason why this founding team has a right to win in this market? Okay. If you wake up tomorrow morning and say EdTech is really hot and you go launch an EdTech company, you might get lucky and raise financing, but no tier one VC is going to invest in you because you don't know anything about EdTech. Right? And you're competing with people who actually have a lot of experience with EdTech, right?
EdTech,
So that's one. Number two is customer love or user love. We talked about that. Number three is viable unit economics if you've launched, right? Now, there are businesses where you have distribution first businesses, right? What I mean by that is you're not a revenue first company, you're a distribution first company, right? Let's say Katabook. Katabook now has 8 million active merchants on their app, right?
Absolutely, yeah.
Their cost per merchant acquisition is very, very low, right? Their strategy is very simple. They'll acquire merchants and then eventually they'll monetize and they're running some experiments, whatever. So that's called a distribution first business, right? Google, when they launched, first got hundreds of millions of users to use the product. It was all organic distribution, no paid distribution. If it was paid, is very little. And then you start monetizing through advertising. So in that kind of business, you have no revenue. So you can't be CM1 minus, you can't be CM anything, right? Correct. What you're looking for there is, and those are the kind of businesses where you need extraordinary product market fit. Right? Because if you have 10% monthly retention, forget it. You're not going to how's that business going to grow, right? And then there, it's okay, right? We're okay to wait 5-7 years and then monetize, because once you have a large base of highly sticky customers, then you can start doing things, right? Either commerce, you can do ads, you can do financial transactions, whatever it is. But if you're a revenue first company,
correct,
that's when unit economics, and it's changed a lot, right? So I tell my founders here, are you building a 2019 company or 2020 company?
Yeah,
2019 company is basically growing despite being deeply unviable. A 2019 company has low gross margins and negative contribution margin. And a 2019 company assumes the only way they're going to have a business is to raise their next round of financing.
Correct.
That's 2019. So what I can say is 2019 is over. Now we're at 2020. So you have to build a 2020 kind of company.
Yeah. I know it's actually been a very interesting reset for a lot of founders, because I think that whole bubble about living funding to funding has seen some sort of collapse. At least that's what we've been observing. So that's an interesting aspect. And I completely appreciate this point. It's a very interesting point of our distribution first business, because when I look at models like TikTok or any of these new age businesses which are trying to acquire users today, and obviously I'm sure over the 5, 7, 10 year journey, there may be, whatever ways they use to monetize the business. So just getting out of the entire, founder conversation, one slightly macro, because you mentioned about public tech companies getting those kind of valuation premiums today. And obviously you've been an ardent early stage tech investor. In your understanding, Rajan, from macro perspective today in India, maybe, what sectors do you think needs that tech, I won't call it a revamp, but that implementation and adoption of technology, and which sectors do you see that, undergoing a massive change from a technology perspective?
Yeah, so Mihir, I think in India, there's opportunity in every industry, right? Now, because of COVID, there are going to be sectors that are going to have tailwind, right? For the next, call it 12 months. We'll see when the vaccine comes out. And there are going to be sectors that are deeply impacted, right? So today, if you look at it, sectors like international travel, hospitality, offline retail, movie ticket booking, for instance, right? Those businesses are deeply impacted, right? And those won't recover in the next 2-3 months, right? It's going to take 6, 8, 12 months, depending on when we have a vaccine and so on. But on the other hand, you have a set of sectors that have significant tailwind, right? Most people know about these sectors, but EdTech. So pre-COVID, India had about 40 million Indians that were consuming online education products. That number is now 100 million, right? There were, the number of paying online EdTech users is more than doubled in the last 3 months, right? So EdTech is seeing massive headroom. Digital health, right? Everything like telemedicine was illegal as of March 1st. Today it's legal, and there are a bunch of companies that are beginning to scale. It's still very, very early, but we think telemedicine is going to be sort of a large scale thing, right? You look at online fitness, non-existent 3-4 months ago, it's booming now. You can look at mental wellness, right, which is a new category. So that whole space of digital health, right, is going to be a very, very interesting and large segment. Third one really is e-commerce, right? We think this is a tipping point for e-commerce. It's very interesting. Very few people realize this. But in the US, overall e-commerce penetration went from 18% to 28% in 2 months, nationwide. Okay? Yeah. And in fact, the largest online grocers in the US 5x their GMV in 2 months. 5x. You're talking tens of billions of dollars, right? The reason it didn't happen in India, actually, the demand went up 3 times, was because we couldn't fulfill, right? Because a lot of the immigrant, a lot of the labor couldn't move, and we were in tight lockdown, unlike the US. But now what we are seeing is, so there were about 7 million Indians that bought online grocery before COVID. Now that number is about 10, 11 million. I think by the end of the year, it would have doubled, right? So I think e-commerce, especially around essentials, but also in other categories, will accelerate because of COVID. And also direct to consumer brands, right? So there was India has a few thousand direct to consumer brands. These are small brands, right? In beauty, personal care, food, fashion, accessories, whatever. They go digital first, either sell on Facebook, Instagram, Amazon, whatever. And then over time they go offline. So I think those brands are also going to accelerate because again, right, just people are just going to buy more online. They'll be much more comfortable and so on. And then on the SaaS side, we've seen a significant acceleration, collaboration software, remote, work from home software, things like that. And also globally, we've seen significant acceleration in certain segments of SMB SaaS. So I would say, it's a pretty long list of sectors. But if you take a step back and say, look, post-COVID, essentially, every consumer is going to be more digital, right? Because every consumer would have had to do a lot of things online. It doesn't matter who you are. And every business will actually accelerate their path to digitalization. Right, so that's why you're seeing, for instance, Indian Kirana stores, right? I mean, 2 years ago, they were not using any software. Today, 8 million, Kirana stores are using like Katabook software, right? And they don't have a single feet on the street, by the way. It's entirely like digital distribution, right? If you had told me 8 million Indian small business Kirana stores are going to be using like software from Katabook, I say it's not going to happen, right? You have to usually have like, because, they're digital now, right? And now there's a lot of potential if you look at business side on small business, mid-market companies, large enterprise companies. So I would say there are many, look at AgTech, right? AgTech hasn't seen a lot of activity. The first Sequoia investment surge, actually, we had the first AgTech investment that Sequoia made was a surge company. It was called BJAC that we had in our second cohort. And now about 2 months ago, Sequoia invested in a company called Dihan. Right. And we are very actively looking at AgTech now because our view again is, there's several hundred millions involved in agriculture in India, and there's been very little software that has been used. Right. And you'll see some innovative models that will come up in AgTech. So my view, Mihir, is, there is, opportunity for innovation in every sector in India. Right now, some of them are going to have a temporary setback because of COVID. And so so today when I look at new companies, some of those companies I'm not focused as much on because, for the next 6-12 months, who knows how long it's going to last, right? But on these other side, EdTech, health, digital health, SaaS companies, we're very excited about.
No, which is very interesting because, in fact, that was one of my points that, we've seen a lot of these. I was just listening to one of Swiggy's calls, and he mentioned that there are a lot of these Kirana stores now that are using Swiggy's platform to ensure that they're still delivering and they're still in the market. And what we're seeing across that entire mom and pop shop segment, a lot of these guys have adopted digital ecosystem. But what's your sense in terms of the longevity of this? Do you think this is going to die down once the vaccine is there and once you get back to equilibrium, or there's something that digital savviness has also been developed by these small business owners and not just consumers?
Yeah, no, look, I think we're going to, obviously we won't be at sort of, if you say there's been a significant jump, right? We won't maintain that post-COVID, right? So because people are going to start going out, they'll start, but you would have reached a new normal. right? Let's take telehealth, right? Telemedicine. I mean, look, it was illegal. Telemedicine was illegal in India in March. Now it's legal, right?
Yeah.
And if COVID lasts another 6 or 8 months, which is likely going to be, a lot more consumers are going to use telemedicine, right? In fact, we were in a government meeting today, a couple of our partners, and it's a huge focus of the government, right? So you look at some of these sectors. Some sectors that didn't exist would have arrived. Other, like online education, has clearly reached a new normal. So you won't see sustaining at peak levels. And by the way, we're not at peak levels, right? Because India is at what, 800,000 cases. We'll hit 1,000,000 in 3 days or whatever. No, we're at 850, right? We'll hit 1 million cases by Friday or Saturday. We're going to be at 3 million cases by end of August, easily.
Correct.
So, we are still like not even 1/3 of the way there, right? So things are going to get much worse before they get better, which means a lot of these consumer behavior, like online buying, digital health, online education. My daughter is 14, she goes to school. Her school next semester is all online. Right?
Yeah.
Which means all her teachers are going to get used to teaching online. Her piano teacher is online. Her math teacher, everybody is online.
It's actually a very interesting ways of livelihood, and that's what we've been seeing also. A lot of these tutors who never might have experienced, what is teaching in an online setting, like teaching a class of 60 or 70. That's changing, and I think so that's something that we've seen with some of the businesses as well, and that's an interesting trend.
Look, think about it, right? What's very interesting is a lot of people don't think about this enough, right? Like, I don't know how many of you, have like I used to have a trainer, who used to come home, right? Now I do it on Zoom. Yoga, not trainer. I do yoga every day. So now, like, he, dials in a few times a week on Zoom. Everything is on Zoom, right? Look at this. I would have probably never talked to you guys, right? Because, I don't know where you are. I'm always on the road. But now on Zoom, boom, you can get it done. It's 1 hour. All I have to do is dial in
and
engage in a conversation and then move on to my next conversation, right? I don't have to fly to a different city. I don't have to check in some hotel. I don't have to wait in 2 hours for traffic to get to your location. So all of these things, I think this sort of behavior, a lot of it will not go away here. If you talk to consumer experts, what they say is, if a consumer does something every day for 60 days, a habit forms, and it's very difficult to change that habit.
No, fair enough.
Shall we take some questions, Mihir? I see there are a bunch of questions. Shall we take those?
There are a bunch of them. So we'll also, we also have people raising their hands, but let me just start with the Q&A box, Rajan. So one of those questions which was interesting was, obviously, why is it very difficult for people who are in early age bracket of about 18 to 21, which I think, which is an interesting question because we've not seen too many of these guys, but to raise money, although they need funding to create something huge, but due to money crunching or bare minimum cash, they can't really, do that startup. So what, unless like someone is 20.
Yeah, no, I think it's a good question, Mihir. Look, so I want to remind everybody that, Mark Zuckerberg launched Facebook while he was in his first year at Harvard. Bill Gates launched Microsoft while he was an undergrad at Harvard.
Yeah.
Right. Michael Dell launched Dell. I work for Michael while he was an undergrad at Austin University. Right.
Correct.
I think what is important is to do something where you can do it. See, the thing is, Bill Gates was coding since he was 8 or 9 years old. Right. Mark Zuck knew how to code. Right. So they built software products. They knew how to code. Right. Michael started assembling PCs because he had been working on computers since he was like a 10-year-old or whatever, right? So the thing is, if you're going to build a company, number one, especially if you're, it doesn't matter, by the way, whether you're 20 or 30 or 40, right? Solve a problem that you know something deeply about and solve it yourself. See, if you're 18 or 19 and you're enamored by building an edtech company and you're not deeply familiar with the problem and you don't know how to code, and you haven't really taken the time to really go and learn about product management and digital distribution, who's going to give you money?
True.
So see, founder market fit. I would encourage everybody to, webinar 1 and 2, right, of Surge and Startup India. Actually, let me try to find it and I'll post it on this link. Please go and watch that, because this notion of founder market fit, right? Look, if an 18-year-old came to me and said, look, I have faced this problem for the last 3 years while I was in high school. And now I just landed up at, whatever college, right? I don't know, Symbiosis, so it doesn't matter what it is, right? And I still have this problem. And for the last year, I've been obsessed with it. I've been building this product to solve it. And guess what? I launched it and now I have 10,000 users. 90% of them are active 6 months after they started using it. I would say that is a founder I want to bet on. You know why? It's a problem that they had. It's a problem they care deeply about. They built something, they launched it, and it sticks and it shows customer love, right? But a 19-year-old comes and tells me, look, I want to launch a company because, you know, this XYZ space is really hot. And I want to raise $200,000 to go hire people. I'm like why?
Not true.
What is your right to win in that market, right? It's a very important founder market fit. Very important concept.
I would love for you to, if you can post that link on the chat, I think everyone can access it. But we have Aman Kothari who's raised his hand. So Aman, I'm going to unmute you. You can ask a question directly to Rajan.
Hi, Mr. Anandan. This is Aman Kothari. Thanks for taking my question. Like you said, I've started up in the e-learning space for MSMEs a bit over a year ago, and I actually saw our first paying customer last month during our beta testing, and also I'm happy to report that we'll be applying to Surge within the next day or so. So my question was that at our company Certurn, and honestly for me personally also, we believe that there is no right age to start a business. However, what I have noticed is that a young founder's age is seen as a con in a pro and con analysis. So given that I am 18 years old, do you have any thoughts on or guidelines for me on how to navigate this, and also about the founder market fit that you talked about?
Yeah, Aman. So look, don't try to raise money. Build a company. Make investors find you.
Right.
Why do you need to raise money?
Actually, due to some family events and stuff, our runway got cut a little short. So I have
figure out how to increase your revenue, Aman. Figure out how to increase your revenue. Remember, Sanjeev Bikhchandani, best source of funding is your customers' money. You've already got your first paying customer. Go get 100 paying customers. How many paying customers do you need so you can pay the minimum bills? You're 18 years old, right? So you're in school, I assume. You're studying somewhere, or what are you doing?
I'm doing engineering. I just completed my first year.
Fantastic. So, you know, your dorm is paid for, your school is paid for. You got all these like coders, you know, your buddies who can code for you for free. So you don't really need any money. So, you know, how many customers do you need so that you can cover your hosting costs? Your only cost is hosting, right?
Yeah.
So what is your hosting cost? Let's do the math. Let's do it real time.
So I would need about 100 customers per month.
Fantastic. That's your goal. Don't sleep until you get 100 customers, Aman.
Right.
That's what I would do if I was you. See, that's what I mean. You know, too many startup founders now, they become, the objective becomes fundraising, no? As opposed to saying the objective is to build a company.
Right. So
you should apply to Surge, right? All I'm saying is, you know, think like what I just said. Think that way as an entrepreneur. When you think like that, you do things differently.
Right. Got it.
So we'll just, I think we have Savan Ladda who's wanting to ask a question. So Savan, I'm unmuting you. Savan, go ahead and ask a question.
Yeah. Hi, how are you?
Very good, very good. Go ahead, Savan.
Okay, I just wanted to ask you one thing. We are expecting another surge of COVID, or you can say the second wave. So what do you think, till what time this would, like, you know, what do you feel like, again, the entire country would get into lockdown in August, September? Or what do you feel like, you know, as overall as a business, what do you see, what is going to happen next 2-3 months?
Look, if I knew the answer to that, I would not be sitting here talking to you guys about startups and fundraising, right?
No, but
look,
you know, what is the prediction?
You know what? I don't mean to be. Look, I don't know. All I know is that we're going to reach 1 million cases in the next 4 days, and we'll probably get to 3 million cases by end of August. And who knows whether at that point we'll peak or whether it'll keep going. You're already seeing, right? Like Bangalore is going into lockdown as of tonight. Chennai has been in lockdown. So I don't know whether we are going to have a national lockdown or not. But you know, it's probably to be expected that we are going to go through many months of opening up, closing down. It'll probably be at the city level. I don't know whether we'll go into a national lockdown or not. It's
Because
too
like
early
city
to
like
tell.
Indore, we are completely open right now, and we are completely open. We are operational. We're just trying to recover from where we were before lockdown. But still, things like that. Again, we will be in a lockdown. So these things are currently disturbing us and our employees as well for the business.
So Savan, that's the way it's going to be. So you should assume that there are going to be more lockdowns. You should assume that Indore is going to get really bad. And that's why, you're a founder, right? So you've got to then plan for that. How do you run your business? How do you make sure you have enough cash runway? How do you run your business from work from home? How do you make sure the employees that do have to be out there, whether it's in warehouses or factories or delivering product, that they are able to be safe? Look, guys, this is the reality. We are 4 months into COVID. This is not going to end anytime soon. It's going to get much worse before it gets better. So, one of the things is when you accept reality, then you say as a founder, okay, now let me go, figure out what to do. So Savan, look, it's going to get really bad. So now plan for that. Assume it's going to get really bad. Figure out what you're going to do.
So one interesting question that I saw in the Q&A box, Rajan, was about culture. And because obviously Savan was mentioning about team and all of that. So it says that in today's time, how important is culture for startup and how do you ensure startups have great culture? So any observations on that?
Yeah, mission and culture are extremely important. If you're a startup founder or you're part of startup, make sure that you guys have a mission that is truly inspiring. Because see, when you go through periods like this, what holds people with you, what keeps them to you, what keeps you going every day, what keeps you wake up every morning and wanting to go and fight the battle, right? As Savan just asked, look, it's bad. It's going to get much worse. Is the mission, right? It's the purpose. It's the reason why you're doing what you're doing. So make sure you guys have a mission, every company, right? And it's not just a mission that you write on a wall or something, that you guys deeply believe in. This is why we're doing what we're doing, right? And by the way, if you're going to be a successful startup founder, it's going to become your life's work. You're going to do it for the next 10, 15, 20 years, right? Sanjay Bikhchandani, he's been doing it for 30 years now, right? It is his life's work to build InfoEdge, right? So I think in terms of culture, it's very, very important, right? In fact, there's a session that X by 10X is running called Culture Eats Strategy for Breakfast. Culture is really important, right? Culture is basically the values of your organization. It is what is important in your organization, right? So if you look at Google's cultural values, I won't go through all of them. I was at Google for 8 years, Mihir, as you know. Thinking, moonshot thinking, right? Thinking big. We want everybody to think really big, right? Transparent, right? Ideas come from everywhere. We believe that the best ideas can come from the person who just joined, or the best ideas can come from outside. Follow the user. Everything else, focus on the user. Everything else will follow, right? Make sure you're building products for the consumer and prioritize everything around what the consumer wants, not what your revenue team say or whatever, right? So culture is really, really important. And in fact, in Surge, we focus a lot on culture for our Surge startups, because we believe that that's what helps you create an enduring company, right? At the end of the day, look, the question is not whether you're going to raise your next round and become a unicorn, right? The question is, when 2040 comes around, which is only 20 years from now, would you have built a company that you're proud of, that your teams are proud of, that India is proud of, that the world is glad is around? That is the only thing that matters, right? And to do that, you've got to have a culture that is deeply strong, that is deeply engaged. And most companies have a crappy culture. They treat people like crazy. Their attrition is high. They yell at people. They scream at people. Those are, by the way, terrible cultures. So if you're running a startup and you yell at your people, you are running a terrible culture. I can tell you that right now. And I can tell you this because I see them every day, right? If you have favoritism, that's really bad. You have a meritocracy where people believe that the way you get the way you advance in your company is by performing better, right? Do you have a meritocracy? Do you hire the absolute best talent? What do you do with your high performers who don't abide by your cultural values? Do you keep them or do you get rid of them, right? So these are the kinds of things. So I answered more than your question of culture, but mission and culture are supremely important. And it's never more important than the period that we're in right now. Because all your team members, right, whether you know it or not, you all know it, they're all deeply worried, right? They're worried about their jobs, they're worried about their health, they're worried about their families, they're worried about the economy, right? So, this is the time where, how do you bring them together and hold them together? It's by having an incredibly inspiring mission. And it's by having a deeply deeply, deep, like set of cultures that you believe in. By the way, culture is not something you put on a whiteboard. Please don't make posters of your culture and put it all over the office. Live it every day, right? Because cultural, values that you live are the values that last.
True.
Values on posters are just that. They're values on posters.
Yeah, posters are a debatable thing today. But Rajan, how much time do you have?
I think we have a minute left. No, remember, that's why I said you start on time, you end on time.
So should we take one more question?
Yeah, we'll take one more question. Then
Okay.
we'll wrap.
So Kunal, I saw you raising your hand. Please go ahead.
Yeah, hi. I just wanted to ask one thing here, that you mentioned 3 metrics that you look for in a seed stage company. First you mentioned was founder fit. Second you mentioned was customer love. Third you mentioned was unit economics. Now, somebody who is making a SaaS company in India probably requires a lot of money to make a SaaS company, because most SaaS companies in India generally export their SaaS to the US. So how would you then apply this like to a SaaS startup, like to a Series A like SaaS startup? How will you then, what metrics will you look at for their funding?
Yeah, so it's a great question, Kunal. So first of all, at seed stage, so at Surge, for instance, the program that we have, right? We have a lot of pre-launch companies, which means they haven't launched anything, right? So the earlier you go, the more important, earlier the investment is, the more important the founding team becomes, right? So for instance, a SaaS startup that we would invest, let's say pre-product, we have several of them, right? We have many of them we funded pre-product. There's extraordinary founder market fit. What does that mean? These are people who built SaaS products before, right? They deeply understand the problem that they're trying to solve. They can tell you to the nth level of degree, both the problems that they're going to solve and the approach that they're going to take. That's number one, right? Second, because they haven't launched, there's no customer love and there certainly isn't traction metrics. So I would say, and both at seed stage, and I used to be an angel investor, right? As an angel investor, look, the only thing I really looked for was, is this a founding team that I believe could build $1 billion company? Right? Actually, as an angel, if it's a $100 million company, that was pretty good because, you went in very, very early, right? So I would say that's the first thing. Now, if they've actually launched, by the way, if you launched them, again, right, it goes back to the question that I think our 18-year-old asked. If you're a very strong SaaS team, founding team, right? You've got a head of product, one co-founder is product, one co-founder is engineering. You could probably get somebody who can come and help you with distribution. You should be able to build your product without a lot of funding, right? Like as an angel, I funded SaaS founders who actually launched a product, built it, launched it, got their first customer, one person. Why? Because founder market fit. They're coders, they're serious engineers who know how to build software, right? So I think this founder market fit is very important. And look, if they've launched and you're investing, let's say as angel, sometimes you're looking at a company that's launched, right? Really make sure that they're solving, especially now in a COVID environment, that they're solving a must-have problem for enterprise or small business, right? And if it's small business, you look at churn, by the way. It's pretty simple. SMB SaaS, just look at churn. 1% great, 3% bad, 5% terrible. That's it. Those are the metrics, okay?
That's as simple as it gets.
Yes.
No, but the thing is, Mihir, it depends on the business.
Business, yeah.
It depends on the business, right? So enterprise SaaS, for instance, 1% is terrible. Enterprise SaaS, 1% churn, revenue churn is very bad.
Yeah, true.
But SMB SaaS is okay, right? So because the CAC is much higher, right? So SaaS, CAC is much higher. So I would say, look, if they've launched, look at customer love, and then traction metrics. Look, unit economics is only if they're a post-revenue company, and in SaaS, look, unit economics are generally pretty good because the cost of usually you're making more revenue than your LTV to CAC is pretty good, right? So I would say if you're looking at a SaaS company in India, then look at, one thing I didn't talk about is look at the addressable market. Is it large enough?
Yeah.
Because you can build a lot of SaaS features. This is a feature company, right? It's not a company. So I would also look at the addressable market to see that the market they're going after is large enough for you to be able to build a large company.
True. So Rajan, I think we've obviously run out of time, but 2 things. One is if there is any way, so because we have a lot of questions, but if there is any way they could reach you, would love for them to reach out to you directly for any questions that they might have to you or your secretary or however you would be comfortable. Second, if there's that link that's available, otherwise.
I just shared that, Mihir. So look, if you're applying to Surge, just go ahead and apply to Surge. Otherwise, I think these 4, I just shared those 4 links, part 1, part 2, part 3, part 4. If you're a seed stage founder, You should watch all 4. It's only 6 hours. And again, right, what I find is not enough Indian founders actually do the work. You know, do the research, be up to speed, learn the game, and do that. And Mihir, thank you for hosting me. It's wonderful to see all of you.
Thank you so much, Rajan, for being a part of this. Sorry, we ran a little late, but thank you so much. I think it was very engaging. And yes, we'll be in touch. Thank you, everyone, for attending. Wish you guys a very good evening.
Sounds good. Thanks, guys. And please be safe. Take care. Bye.
Take care.